do you want to be a stock picker? What is going to be your edge? What makes you think that you can be a better stock picker than many others? I started making more money from markets than my usual salary. So after outperforming my own income from salary for like 5 years or so, I quit full time and started doing this. If you're only looking for dividends, I guess you're missing the point here completely. The point is you're going to own a business and you're lucky if the business is paying you. Who would not want to own Berkshire Hathaway stocks 10 years ago, even though they don't pay dividends? 85% of the active fund managers actually underperform S&P 500. If you're someone who wants to build a dividend income stream, try to attain 3 key ingredients. First, education. Number 2, knowledge. And number 3, the right temperament.
Investors, welcome back to another go-round of Masters of the Market. Now this week, I am incredibly honored and excited to have on with me Sanjeev Kaushik, who is an investment advisor and an investment coach when it comes to all things investing. So Sanjeev, first and foremost, welcome to Masters of the Market. And I want to get started here, pass you the first question and ask you about your story and how exactly you came to be where you are today.
Thanks a lot, Ari. It's really my own pleasure to be here with you and speak to you about everything related to markets. Always excited to talk about stocks, ETFs, investments, and dividends. And I believe we're going to have a really good time here talking about investment ideas as well. And I'm hoping that your audiences would also enjoy this talk. All right, about me, I started investing in markets in 2007, right when my career began. I was very, very interested in stocks, but I started investing right at the top of the bull market. And then I saw the crash coming in, the GFC 2008 and all. And to be honest, I wasn't really learning too much out of it, even though they say that bear markets are the best teachers. But I was just a beginner. But from there onwards, I started learning more and more about finance. I had also started my career as a software engineer. So whatever additional income that I had from trading and investing, that was pretty much used for partying and stuff. So I never did the long-term investments. So that's one of my regrets. However, I started learning about finances, derivatives, how to trade them, how to invest, and so on. And I did that from 2007 till 2021 as part-time. And from 2016 onwards, I started making more money from markets than my usual salary. So after outperforming my own income from salary for like 5 years or so, I quit full time and started doing this. And then I was approached by an investment advisory firm here in Sydney, Australia. And I joined them as a stockbroker and investment advisor. So now I help my clients trade and invest in markets. And at the same time, I also manage my own family fund. So that's my story. And we trade and invest everywhere. We keep track of the global markets, the local markets. We heavily invest in the US markets, commodities as well. And of course, very close tap on ETF investing as well. But when it comes to learning how to invest, and if you're a beginner, I would say try to attain 3 key ingredients. First, education. Number 2, knowledge. And number 3, the right temperament. And they're not mutually exclusive, and usually you attain them in exactly the same sequence. First, you understand the theory part, which is the education. Understand how the markets work, how companies work, how different industries work, how to read balance sheet and annual statements and so on. Right? So that's your theory part. Then the know-how part, the knowledge part, how you can now use all that theory and implement in the markets to make money. But you're just not ready yet to be able to make money profitably. And that's possibly also the reason why 90% of the people never make money from markets, because you don't have the right temperament. And that comes from the practical application. Sometimes even learning from other people, how they're making their decisions, how they're riding a trend, how they're not doing any premature decision making, be it entering prematurely or exiting prematurely and so on. So a great parallel here would be learning to fly a plane. First, you read about the manuals, a whole bunch of books on how to fly a plane, and then you start flying in a simulated environment, and then under someone else's observation, Ultimately, you do that for say 1,000, 1,500 hours or so, and then only you can apply for your own commercial pilot license, right? So stock markets are no different. Just because the barriers of entry are so low that you can literally open your account within minutes and then fund it and start buying stocks within 5 minutes, doesn't mean that you become a good investor or trader for that matter within that span of 5 minutes. So yeah, entry of barrier is low, but the barrier where you have to cross and then become a profitable trader or investor is rather high, and you have to work towards that. And I would also say try to discover yourself. Not everything that you would come across would align with your personality type, the kind of investor you are, or the core competencies that you have. Usually our core competencies are determined by our qualifications, the areas that we've worked in, the industries that we've worked in. So we understand certain industries, certain companies much better than others. So if you want to be an active investor, if you want to pick companies for investments, then you might as well learn how businesses operate, right? It's very important that you know your own core competencies and then only find the businesses within that core competency, so that you would know that, okay, fine, I'm reading this in this company's annual statement, or if this company's investor meet, the CEO said this thing. I'm not hearing what I want to hear as an investor. So now time for me to exit. Unless you don't really get to that level, I don't think your education, knowledge, and temperament is where it should be in order to be able to become a stock picker for yourself.
You know, it's interesting. I almost feel like, and you said it best, the barriers to entry now, or at least these days, are so low because of all the apps. Maybe it's, Robinhood or Webull, or any investing platform really does allow you to just kind of become your own CFO. It's alarming in some sense because I feel a lot of investors jump in and they throw a lot of money into the market and they can easily lose it. But at the same time, I mean, investment advisors notorious for these high fees and almost, I don't want to say robbing people of their money, but to some extent, like, you could do this thing by yourself. So I'd love to ask you, Sanjeev, at what point should an investor go towards the investment advisor, or should they stray away and try to do this thing on their own? What's your take on it?
Firstly, you mentioned about Robinhood. I remember reading in a forum where some um, investor had asked a question: if I don't like a stock, can I return it? It's not like you're buying a product on Amazon that you can return it afterwards. So if you're coming to the markets with that level of understanding of how markets operate, you probably should look to hire an investment advisor for that. There can be many reasons for people to reach out to an investment advisor. First and foremost, the kind of clients that I prefer to onboard are the people who are busy making money in their own world, and also understand and appreciate the fact that you can take tiny bit of risk in order to make really good returns from markets. So they are the ideal candidates for me to onboard as clients. However, if you're actively looking for some other investment advisor, I would say first ask the question why you're going to them. What is it that you cannot achieve by buying some ETFs passively, some blue chip companies passively? And what is it that that person is offering you in terms of the edge? Because here you're not necessarily betting on the markets, you're betting on that person's ability to pick the winning stocks in future. And it's very important. Sometimes people go to advisors with unrealistic expectations, and they'll only get disappointed. If you're expecting for them to give you 35, 40, or even maybe 2x returns in 1 to 2 years, that's not going to happen. They don't have the magic wand, right? And it's a very important decision to make as well, because if you underperform for 1 to 2 years, and if you're at your prime age of investment, in the long run that will hurt you really. So if you're someone, even if you're going with investment advisor, it still doesn't harm that you educate yourself about markets. You will be better equipped in segregating the good managers from the bad ones, which is equally important as well. But if you're still looking to go with someone, I would say look for the people who have got a really good track record. Having said that, they must keep in mind that 85% of the active fund managers actually underperform S&P 500. And if you increase that time frame of study, the number drops down to 92% as well. The very first question that you should be asking is, what is your benchmark? What is it that you would look to beat as an advisor? How are you going to manage my capital if they're going to give you that one-on-one advisory service and so on? And for example, a lot of my clients come to me because they want to do active trading as well, right? They want to be able to hedge their existing holdings if they think that the markets are now getting top heavy and there can be some kind of a mini crash, a minor sell off around the corner. So they want to hedge themselves. So we use options, we use futures in order to protect their existing stock holdings. So if you want to get that much fancy with your portfolio management and all that, by all means, go with an expert. But if you're confident that you can do stock picking, I would say at least give it a go before looking outside, because this is a skill once acquired, nobody can take it away from you, and you'll probably pass it on to your kids as well. So it becomes a family affair. Then it becomes a lot of fun as well. You start building wealth together.
I must feel like from a skill, it also turns into a passion, at least for people who are probably viewing this right now. It's like, okay, we started off with just trying to build the skill, and now it's just become a passion. You're addicted to it. I'd love to ask you, where exactly should someone start in the event that they are ready to dive in, start investing? They're not going to go with the advisor. Do they just go towards ETFs? You're also heavily oriented into futures and options. Is that a path we should jump into first? What do you think is the best approach?
You need education for anything you're going to do. For options and futures, you 100% need education. If you don't understand the instrument, if you don't understand the product, you'll definitely end up wiping your account because you can lose more than you've bet on a particular trade. Where you should get started, I'll say start off with something as boring as understanding what ETFs are and how you can invest in them and how they actually work. For example, S&P 500 ETF, right? So you can go pick a SPY or a VOO. Just see how it works and why in future you should expect it to keep going higher, because S&P 500 as an index establishes a merit system. So if as a company, if you're underperforming, you will be thrown out and then an outperforming company will be added. So by default, the way these indexes are set up, they are set up to only include the blue chip companies, the best 500 companies, which tells us that as long as the US economy is going to be fine in future, as long as it is going to grow, then the S&P 500 should also keep growing higher. Once you know this fact that despite the market volatility, despite the I would say a few sell-offs here and there within a year, 5%, 10% correction, you know that by and large, these ETFs are going to go up. If you have that level of certainty in your mind about your investment, now the next question you have to ask is, are you happy with the index return? Right? If you say that, okay, fine, 9-10% return every year, if I'm going to get, I'm happy with that, then this is where your education by all means can stop as well. This is vanilla, this is boring. I know 99.9% people would never do that, right? Next ask is, then do you want to be a stock picker? What is going to be your edge? What makes you think that you can be a better stock picker than many others? That's where the actual education comes in. And then you have to decide, how will you pick those stocks? Will you follow, let's say, technical analysis? Would you follow fundamental analysis? Would you follow a mix of two? Or would you just follow some other guru who shows up on a TV channel? I would say just do not go with the third option. If you really like someone who's showing up on a TV channel, see what they have to teach. If they have authored a book, go read that book. If they are talking about the systems that they follow, try to learn those systems. So it's not like I mean, of course, if they are showing up on a TV channel, I'm not one of those people who bash all of them. No, I'm not saying that they're all ridiculous. It's just that try to learn from them. I'm stressing on the point of learning the skill by yourself. Let's say you ask me, where should I invest today? I tell you that, okay, fine, go invest in that company. You will have to keep asking me on a daily basis or a weekly basis, because that pick is not yours. This is my pick. You don't know where you should be exiting, when you should have entered. You'll have to keep asking me. So your dependency on me would always remain there as long as you're invested in that particular stock. Same is the case with following someone who's coming on a news channel. But if they have a course, if they have a book, by all means, you should look to learn from them. Now, technical or fundamental analysis is purely a personal choice, but you should know as a person which one do you favor the most. I, as an individual investor as well as trader, I'm pretty much comfortable with both, right? So I can take decisions purely on the basis of technicals and purely on the basis of fundamentals as well, even if I'm taking my long-term investment decisions. So over a period of time, I've built my own systems that favor both equally. However, you have to decide first and foremost what is going to be your criteria going forward, right? And where in this entire system lies your edge. So if someone wants to, let's say, outperform S&P 500, then they don't have to get too fancy. Just go and buy the 10 biggest companies in S&P 500.
When it comes to passive investing and active investing, I'm always one to say that macros do in fact matter, not necessarily to time the market in and of itself, but just to understand what sectors to begin to look into and where you may find stock opportunities. So with that being said, do passive investors really even need to look to macros at all in order to understand where to invest, or is that really just more of the active investor that needs to look at macros?
The short answer, only active investors. But let me just talk about it from the passive investor's point of view. You can't really call yourself a passive investor if you're tracking the macros, if you're tracking the markets, and so on. For me, the definition of a macro investor is someone who picks the vehicles to invest in and then does so regardless of the market conditions, right? And the moment they start switching the sides and go on to the active investing, or even just tracking the macros, that would end up influencing their decision. To give you an example, let's say you're invested in banks, right? You've invested in XLFs, which is the sector ETF in banks and non-banking firms. And now you think that, no, technology is going to do better. So let me just sell off all my investments in XLF and let me just buy XLK as a result. And because I'm a passive investor, I'm going to hold it for next 2 years. What you just now did is an active bet on two sectors. One, that the banks are going to underperform, and number two, that the technology is going to do well. You are not a passive investor. A passive investor is not someone who buys every day, every month, and so on. A passive investor is also the same person who invests regardless of the market conditions, right? And for me, a passive investor should only stick to, say, index funds or the sector funds. So broadly, you can classify those into index and sector. And then if you want to get fancy, if you want to actively pick your ETFs, then you can go with someone like Cathy Woods. So there you're betting on the fund manager, not necessarily on individual sectors or industries. However, if you are an active investor, then yes, it makes a lot of sense for you to be tracking. But often people do a mistake of thinking that they are passive, but they in a way are active, where they are constantly betting on one stock or the other, or maybe selling out the stock and buying the ETF, but then see the stock doing well and then switching back to the stock. So it's very, very hard, and I can understand why people do that. However, passive investing is easier said than done. A lot of people can't do it. If you are going to follow, say, a passive investing approach, and if you can't hold yourself back from not staying passive investor for a long period of time, then what you can do is you can follow satellite approach, which is what I recommend to clients. If you're someone who wants to be passive but also want to keep the macros and take the active investing decisions, then I would say invest a higher proportion of your capital in the core passive investment funds, say S&P 500 and so on. Say 50% of your investment will go into that, and then the remaining 50% you can do your active investing with. So at least 50% of your portfolio is giving you the market returns. And now you can see whether the remaining 50% is outperforming or underperforming. But to answer your question shortly, if you're passive, you should completely ignore the markets. If anything, you should be looking to buy when there's blood on the street.
Let's talk dividends for a hot second. A lot of investors who are out there love dividends for the sake, again, of passivity, the passive income that can come in on a monthly or a quarterly basis. And then there's this dream of retiring early, which everybody's after to buy their time back, if you will. Is this a pipe dream with dividends? Can it be achieved? Or are we kind of just chasing our own tail here and pouring a lot of money into dividend stocks and not getting the returns that we actually want? Because there's a lot of investors too, at least that I've come across, and I will even say it outright. I used to be one where it was like, I am only going to be focused on dividend stocks. And that was a naive approach about a decade ago, right? Because it's like you can marry growth and dividends for even better returns, and it's ultimately about total return. But is this a pipe dream with dividend income to retire early?
Let me share a trivia with you. You'll find it interesting. In 1994, Warren Buffett bought Coca-Cola, right? I think he bought 1% or a little under 1% stake in the company. And he invested $1.3 billion in 1994. In 1994 itself, they received 70 or $75 million in just the dividends from the company. And the dividend they received in 2022 from the same stock holdings is a little over $700 million. So, and every year, Coca Cola since then has been increasing the dividends that they're paying out. So, firstly, as we established, it's a very good sign if the company is growing their dividends, right? Now, this I'm talking about an extreme example. Now, we are mere mortals. We're talking about Warren Buffett, Berkshire Hathaway, we're talking about Charlie Munger. Now, they made a lot of wealth, and now the holding in Coca-Cola is a little over 5% of Berkshire Hathaway. It has grown so much. I believe as we speak today, their holding has grown from 1.3 billion to almost close to $30 billion in today's stock price terms. So there you have it. You have both the dividend income as well as the capital growth, right? Anyone who says otherwise is completely wrong. But not all dividends are created equal. Not everyone would have the right temperament of buying Coca-Cola in 94 and still holding it. You would have sold it off like 100 times already. Um, so if you're someone who wants to build a dividend income stream, you'll have to understand the markets first. That is, not all dividends are created equally. Warren Buffett in the same period must have sold off many companies that might have an even higher dividend yield than Coca-Cola. Amex is also a really good example. They pretty much invested the same amount, and the dividend that they received in 2022 was about $300 million. And they had invested the same amount, $1.3 billion in Amex back in 94, 95. So firstly, when you're investing just for dividends, you will have to become a good stock picker as well. If you can't do that, then you're, like you said, chasing your own tail. Then there's absolutely no way that your strategy is going to work. In such case, you can still go with dividend investing, but go with ETFs. I met with a gentleman. He used to work in Dubai and then he moved here in Sydney. He bought the property for cash and he was sitting on $1.5 million worth of ETF investments in NASDAQ 100 and S&P 500. Now he's receiving a little over $100,000 per year in dividends, right? That's a good position to be in. He's still in his mid 30s. However, I believe his approach is really smart. He kept on buying the ETFs, which is one of the safest ways of not only investing in the markets, but also looking for the dividend income. But if you're purely chasing just the dividend yield, and like you mentioned, probably not the best way of going about it. It doesn't mean that you can't do that. But if you get to that level, you might as well become a professional manager, start managing money for other people, because this is such a highly skilled area that if you can pick the right companies that are also paying really good dividends, you might as well come and talk to us. We'll onboard you as one of our advisors. To give you an example, I bought a stock which is FRO, a small shipping company. Not that small. It was trading around $14, $15 about 1.5 years ago. It's actually 1 year ago. And the dividend yield at that time was a little over 20% on that stock. Right now, that stock is trading around 22 or 23. And even today's stock price gives us a dividend yield of 8 to 9%, right? However, when I made that decision of buying the stock, it was purely based on fundamental analysis. I was not looking at the dividend yield. So if your only purpose is to look for dividend yield, then you're probably looking at it from the wrong way. You might as well just go and look for, say, emerging markets bonds, where you can easily get 6, 7, 8% return on your investments and relatively safe. The emerging countries are going nowhere. But if you're only looking for dividends, I guess you're missing the point here completely. The point is you're going to own a business and you're lucky if the business is paying you. Who would not want to own Berkshire Hathaway stocks 10 years ago, even though they don't pay dividends, right? So it doesn't mean that the investors in those companies have underperformed everyone else. But look at dividends a little carefully. And of course, if you are investing for dividends and if the company starts cutting them down, keep a very close eye on those guys. These are the ones you should be cutting out from your portfolio first and foremost.
I think you hit the nail right on the head in that Warren Buffett like approach of not investing into a company because it pays a dividend. You invest into the company because it is a quote unquote quality company that you can sit on for a long while with great temperament, and icing on the cake would be the dividend. And I think a lot of people, to be honest with you, have that backwards because dividend investing comes with the, passive income allure to it. And it's almost scary. Another big question that's thrown around there, out there, is how many holdings should be in a portfolio? And I've gone even myself back and forth on this one. And for myself, have come down to the notion of less is more. Of course, there's a lot more risk that goes into that. But I'm curious to know from your perspective, when it comes to the number of holdings in a portfolio, do you go with the Bill Ackman less is more approach? Do you go with the, safety is king with, 70, 80 holdings, which I've had some individuals on here talking about having 70 plus holdings. But to me, that's like, go to an ETF. If that's your strategy, that's what ETFs are for. And so I'd love to get your take on that, Sanjeev.
That's a good point. If you have like 70, 80 stocks, you're pretty much running your own personal mutual fund. That's not stock investing. And I'm going to give you an answer that is actually backed by proper research. And I'm going to give you the proper portfolio building model. According to a study, if you have 14 stocks in your portfolio, then you have already achieved the maximum level of diversification. So that's your safety right there. That's what people do. They try to add the stocks that are loosely correlated with each other, right? And that diversification benefit beyond the number 14 is almost zero. So it doesn't matter if you've got 14 stock or 140 stocks, the diversification is still the same. So in my opinion, the best number is 20 stocks. That's it. Ideally, you should be investing equal amount of capital in all 20 stocks. So if you're going to invest 100, invest 5 in each stock. Having the number equal to 20, it sort of helps you establish a merit-based system. The stocks that are performing will stay in your portfolio. And the ones that are not, you'll be itching to throw them out because you know that there is another potential candidate that you can put inside your portfolio. So if you're going to perform, you'll stay, otherwise you'll be removed, right? So if you're going to restrict yourself to 20, you'll force yourself to sell off those that are not performing. Oftentimes, people who've got 70, 80 stocks in their portfolio, you're going to find that most of those are underperforming massively. Why? Because they are trying to avoid the pain of selling a stock in loss, and that's why they're holding 70 stocks. Not that all 70 are performing well. Invariably, and I've personally had the privilege of seeing people's portfolio having 200, 300 stocks in them. And what have they invested in those? Like 10 bucks, 20 bucks, 30 bucks, right? And most of those have actually gone to zero already. So you should go with 20, establish proper meritocracy. If you're not going to perform, I'm going to check you out. Know that the diversification benefit is pretty much zero beyond the number 14. So that's your answer. I stick with it. That's how I build the portfolio for my clients. And this has served me really, really well.
Are there any trends that are out there right now that the massive investors may be overlooking?
It may come as a surprise to you, but I've been accumulating Tesla for a very long period of time. The reason I've started off with this stock is either you will find the lovers of this stock and or you're going to find the ones who hate it. I've been on the hated category for a very long period of time, but somehow I believe it is turning around. Even at the current levels, I'm liking it. But if it's going to drop down by 5-10% in the next market sell off, I'll be looking to buy it. I can talk to some of the tailwinds right now that I am seeing. In fact, if you would have asked this question 2 months ago, I would have said that go and buy China. We bought Alibaba and all at 80, 85, and now Alibaba is, I think, at 110 or so. I still think Alibaba is a stock to buy. So if you see a pullback to 100, say a little under 100, I would look to buy it for the levels of 180 or so in next 12 to 18 months from the current levels. The tailwind that I can speak to is related to the US manufacturing. We are very, very bullish on US propping up the performance of their manufacturing company, propping up their own capabilities of manufacturing, and that directly ties with the tensions with China. US has come to the realization that they can't just put, let's say, import tariffs, because when you impose tariffs on your imported products, you in a way increase the prices of those products for your own consumers. So in a way, those tariffs are being paid by your own people. Rather, and it doesn't matter who becomes the president going forward, both sides of the aisle are going to promote the manufacturing within the country. We are actively looking for those companies, especially the mid-sized ones, that are into manufacturing and have some kind of a pricing power and are going to be the direct beneficiary of the removal of dependence on imports of the products that they manufacture, right? So for us, this is going to be one of the major tailwinds. I am personally also very bullish on commodities. If I were to, let's say someone comes and asks, tell me a company I should be owning for next 10 to 15, 20 years, I'll say go and buy the top mining companies across the globe, right? It's a very old school economy, but it still works perfectly. It fits the bill completely. They pay dividend, they generate massive cash. They may not have all those opportunities to be able to redeploy because there's only so many minings you can have in the world, right? So there's a limited scope of growth. And those who are the top companies, the big companies, they keep on getting bigger because they keep acquiring small companies with, say, a mine here, mine there. So they keep on expanding their portfolio. And going forward, this is where you're going to play on the, I would say, deficiencies in the world, on the commodities, the companies that are, let's say, mining gold, silver. There's only so much of it right now, right? So so you're pretty much in a way, I would say, betting on the limited supply here, and as a result, the prices will go up. So these are the companies that you should be looking for, and because these companies are generating so much cash, tomorrow if they want to get away from mining and want to do something else, it'll be easier for them to do that. They just have to cut the dividends and then slowly get into some other businesses. They can get into green energy and so on. I personally also like, say, banks for a long-term holding, both from dividends as well as the capital growth point of view. You can't replicate banks. Banks can't be disrupted by technology. Blockchain cannot change the way banking works. They still are the most competitive institutes when it comes to lending to the customers. No one can give you loans cheaper than a bank. So these are some of the industries where I am still bullish. I would look to keep buying as and when there is a sell-off. So something that your viewers can also keep in mind.
Yeah, it's interesting that you brought up mining. I'm reading a book right now, actually, which is The End of the World is Just the Beginning. It's about geopolitics. It's not as negative as it sounds to an extent, but it talks a lot about actually various commodities around the world and like what's happening. So you're bringing up, mining and these resources that are finite, and that makes for a very compelling argument about why for us as investors to invest into them, very lucrative bets. Now, I'm also very keen on I'm moving into the future, and green energy will be interesting to see what can happen. And banks, certainly, I like your take on banks. I have one last question for you. Sanjeev, it's my favorite question I get to ask every master of the market who comes on with me. If I were to give you $10,000 right now on this call to actually place a bet or a pick, I'll say, rather than a bet, on one stock to buy and hold for the long term, what stock would that be and why?
Oh, one stock. Um, the philosophical answer would be bet on yourself with those $10,000. But I would pick Netflix for that. And I'll tell you the reason why. I think people are underestimating the kind of revenue that Netflix can generate by simply showing ads to their viewers, which is the lowest tier of subscription anyway. And I'll draw a parallel here with the YouTube business. You see, people think that just because you buy the premium subscription of YouTube, YouTube is making money off of you. But the reality is, if you're a premium subscriber of YouTube, YouTube actually loses money from you, because how much would you be paying? 5, 10, 15, 20 bucks, right? For your YouTube premium subscription. But YouTube could have shown you ads worth $500 in a month if you're a heavy user of YouTube. YouTube loses out on that revenue and in turn gives you the service for just 20 bucks. Now, you reverse the case for Netflix. Netflix is still going to charge you 5, 10 bucks per month, and they're going to show you a whole bunch of ads, and they're going to make a lot of money from those ads. So it's a game changer for Netflix. And as they themselves have said, there's no such thing as too much content. They'll keep producing content. Their content is, I would say, one of the best anyway. And people think 100 times before canceling their Netflix subscription. They have the least cancellations amongst all the services. The second is Disney only, right? Which is surprising for me. But nonetheless, so I would bet on Netflix to keep doing better. So much cash that they're generating. They've got a lot of ways to innovate. But even if they don't, we cannot underestimate the power of advertising and the need of human beings to be served with entertainment, even in future. And this company is very innovative. They have disrupted industries in past. They can do so in future, right? So I would bet on Netflix for sure. I think this stock sooner or later will become a 4-figure stock. And if they don't split, it will also become a 5-figure stock. So I would bet on Netflix. On the same line, I also don't dislike Disney that much. I believe they have their own issues, but they're going to do well just because of the same model that the Netflix has. And Amazon will also be a beneficiary of the same model of showing the ads, right? But if I have to go out of that area, among all the other Mag 7, Meta is also going to do really well. Okay, so these are some of the companies that I would still stick with. So do not rule out these companies. The reason they are the biggest is because they are the best businesses. And you can't ignore them just because they've gone up so much. So remember, in stock markets, whatever goes up keeps going up because someone is buying at all-time highs, hoping that they'll be able to sell at even higher levels. So that's a lesson I learned the hard way. But if $10,000 goes into Netflix, I don't think I'll be very disappointed in future.
Investors, there you have it from Sanjeev Kaushik. He has his own channel as well, which is where I discovered Sanjeev, where we connected. A lot of insights are offered on Sanjeev's channel, whether that's options, futures, dividends, value investing, anything in between. It is all there. So I'm highly recommending to jump over there, give his channel a look. And of course, be sure to join us again next week for our next Masters of the Market chat as well. But until then, Sanjeev, thank you for joining us, and investors, we will see you there.